right, we turn our focus now to finding investment opportunities in the bond market. Arne Espe is Vice President of Mutual Fund Portfolios at USAA Investment Management, which has $47 billion in assets under management. He manages the bond portion of 4 of the firm's funds, 2 of which made this year's Lipper Fund Awards list for their performance over the past 3 years. And he joins us now from San Antonio, Texas. Great to have you on again, Arne. You know, you launched a new fund back in November, the USAA Real Return Fund. Let's talk a little bit about the basic asset allocation of this fund. It's actually an equity and bond fund.
Sure, Lisa. It was the USAA Real Return Fund we launched basically in response to a lot of investor fears that we were hearing from the people that are in most of our other mutual funds, our members, and they were concerned about inflation long term. The difference of USAA Real Return versus a lot of other real return offerings is it's not just a TIPS fund. TIPS, or Treasury inflation protected securities, do offer you over time a guaranteed increase over the CPI. The problem about TIPS in our view is that you've got to go very long term, 15, 20, and 30 years, and you're taking interest rate risk to get a decent return over inflation. So this fund mixes asset classes. It goes into primarily U.S. large cap stocks that we think have pricing power. We also use a lot of shorter duration, high yield bonds and investment grade bonds. Our average yield is roughly about 6% in the bond portfolios, and our duration is fairly short, around 3 years. We also use precious metal stocks, a traditional inflation hedge. We've got a lot of expertise in that area. And we also put a little bit of commodities in there as well, and we can vary the allocations over time.
So Arne, let's focus in on the bond market for just a moment. What is your expectations? We have a lot of people saying that yields should be going higher in light of the fact that QE2 will end in June, and it doesn't seem as if there's going to be another stimulus plan along those lines. In the light of inflation being an increasing concern for many investors, it seems as if yields should be much higher, not to mention you have big bond fund managers like Bill Gross saying that they're actually shorting U.S. Treasuries.
Mm-hmm. We would agree. We see U.S. Treasury yields moving higher over time, particularly on the short end. We have a very steep curve right now. You're at basically 0% on the short end, out to 3.5% on the 10-year, 4.60 on the 30-year. We think rates are going to go up along the curve, but they're going to go up more at the short end, and we see the Fed raising rates probably early next year. Inflation, as you mentioned, is running at about 2.1% on U.S. CPI. We see those numbers going a lot higher over the next 6 to 12 months. We may see 3-4% numbers, and bond yields in U.S. Treasuries are just too low.
We were last talking about where along the credit curve in the bond market you find some value, and one thing you and I were talking about during the break is just how much issuance we've seen amongst different corporations.
Sure, it's a great time to issue. Companies can issue 10-year debt at extremely low yields. The average investment grade 10-year is trading at about a 4% yield, so this is a wonderful time to lock in rates. From an investment standpoint, 4% for 10 years doesn't excite me too much.
Yeah, I don't blame you. So, you know, one of the trades we've been seeing over the last few years, a couple years at least, is this trade into high yield as investors search for yield. Is that still a good trade to be doing? I mean, spreads were extremely tight at the beginning of this year.
They are a lot tighter. They're still about roughly 4.5% or 450 basis points over Treasuries for high yield in general. We're still finding some value there. The easy money has been made, as you mentioned, and we still think there's a little bit of cheapness in high yield. One of the areas that we favor is high yield bank loans. This would be senior secured debt, floating rate, and we can get pretty decent yields without any interest rate risk. TXU bank debt is one that we have a large position in, very comfortable with the credit, and we're getting an expected yield there of about 10% because it's at a discount.
Now, is that what you would classify as high yield debt?
Yes.
I mean, in terms of a credit perspective. And what about, you also like commercial mortgage-backed securities in the investment grade space. Now, a lot of people concerned that we haven't seen the other sort of shoe drop yet in terms of the real estate market. Many people concerned that the commercial real estate market has yet to see its big downturn.
We think the worst is over for commercial real estate. You're already seeing lease rates in office properties on average over the nation increasing. In the apartment sector, you're seeing very good rent increases. So we would say that the fundamentals are getting better. Now, you are seeing delinquency rates on the existing stock of commercial mortgages are ticking up, but we view that as a lagging indicator. So values are going up, and that's more important for being paid back on this type of security.
Arne, what are you underweighting in the portfolio right now?
We're underweight on the run investment grade type names, household type companies that trade at very tight spreads to treasuries. We're also underweight treasuries, and we are very underweight residential mortgage securities. Those are at very tight spreads, and expecting interest rates to go up over time, we don't want to be in those sectors.
And then quickly, we got about 10 seconds here in terms of stocks. You don't like European stocks?
No. In general, we're underweight Europe. We like large cap U.S. consumer products companies and the energy sector.
All right, Arne, thank you so much for joining us today. Unfortunately, we got to leave it there. I know you don't like U.S. small caps as well. We have to have you back to give us a little more insight into these markets. Arne Espe is our guest today. He's the president of mutual fund portfolios at USAA Investment Management.